Well, hello, and my name is Dan Woodruff. I'm a certified financial planner with Woodruff Financial Planning, and in this video we're going to explore 4 expert strategies for tax-free pension withdrawals, to explore some of the ways in which flexible pensions can allow you to take money out of pensions in a tax-free manner. Interestingly, we're also going to explore 2 other strategies which are kind of the ways that things used to work and can still work within pensions, and those perhaps incorrect strategies will are more likely to mean that you are going to pay income tax on your withdrawals from pensions. So as we go through this, it should help you to start to think about ways in which you might want to withdraw from your own pension plan and how you may make that money last longer by avoiding tax along the way. Okay, so let's just think first about how pensions are taxed. So we work with people like you who are thinking about their retirement and putting together a strategy for generating the income they need to fund that retirement. And of course that works in very different ways for different people. So some people have guaranteed income from various sources, including state pension, property, other pension plans, savings and so on. But what we're going to do is just look at personal pension style plans today, and that will give you an idea of how the taxation works. So basically there's 3 stages to a pension plan. There's the contribution stage, where you put money into the plan, and for a basic rate taxpayer, £1 put into your pension plan equals 125 pence, £1.25 actually goes into the plan itself. So you get tax relief on the way in, and that gives a boost to your pension plan. So that's a very good thing. Obviously, if you have employee contributions too, that boosts it even better. Then when the money's in the pension plan, it grows completely tax-free. So what that again gives you is the ability for your money to grow at a faster rate over time than if it was sitting somewhere else like a bank account or a taxable investment. So then if we think about taking money out of your pension plan, this is where tax can potentially hit your savings. So as most people are aware, you can have a 25% tax-free lump sum, and traditionally people would take all of that money in one go and put it into a bank account. We'll explore that in this video, but we'll also explore ways in which you can divide up your tax-free lump sum to perhaps be more tax efficient with your income stage and taking money out of your pension. And the reason for that is that if you take any additional taxable money from your pension plan, it becomes taxable against income. So depending on your other income from other sources, other pensions, property, working and so on, that can lead to a greater amount of income tax. So as we explore the options, we'll see there are a wide variety of flexible ways to take money from your pension plan, including taking the whole amount out, and some of those can lead to a great deal of tax. So one thing just to mention, that there's a lot of complexity with pension withdrawals, so please don't accept this as the full story, because there are many aspects that the qualified financial advisor would explain to you when considering taking money from your pensions. We're just looking at the tax element in this video. One thing to remember is when you take any kind of taxable income from your pension plan, you're going to have a reduced annual allowance for future investments. So if you want to pay money in the future, bear in mind that you're going to have that reduced if you take taxable income out. Okay, so what we're going to look at here is a standard scenario that we would deal with. Somebody with £300,000 in a pension fund, and Sarah in this case is going to look at 6 different strategies based on 6 different needs for people who are in her kind of situation. We're assuming she's got no other income from any other sources, just to make things a bit more simple for the purposes of the video. We're going to take you through 4 strategies that are tax-free and 2 kind of traditional strategies that mean that Sarah would pay some income tax. So remember, there are 2 parts to your pension. There's the accumulation stage, where Sarah's money has gone into the pension plan and has grown tax-free, and that's where she sits at the moment. As soon as she starts to take any money out, we cross this dividing line, which is illustrated here with my dotted line. As soon as you cross over that line, you come into the potential for paying income tax. And now, depending on What Sarah then does to take money further out of the pension plan depends on whether she pays tax. So let's look at scenario 1. I just want my money. Now, when flexible pensions came in, many people thought, brilliant. You know, I've had this money stuck in a pension for years. It's not like a bank account, and all the papers kept talking about pensions being almost like bank accounts or ISAs. You can just take your money and you can run. And yes, that's true. You can take all of your money from your pension once you reach age 55 in the UK. Once you reach age 55, you can take all your money and potentially pay some tax on that and put it in a bank account. And kind of, to a lot of people, they think, well, why wouldn't I do that? Well, the answer is it's grown in a tax-free environment. So if we go back to my previous point here, if you're in the accumulation stage, you're paying no tax on your pension. So if you're over age 55, your pension is almost like an ISA now, because you can take money from that. You can cross this dividing line and you can cut this cake any which way you like to take the money you need at the time. So to my mind, why would you take it all out and put it into a, you would pay income tax, and B, when you put it into another account, let's say a bank account or another investment, you're going to pay more tax on your savings. At the moment, it's grown tax-free. So let's look at that in a bit more detail. Sarah's got £300,000 in her pension plan. She crosses this line and goes into the income stage. She's allowed to take a quarter of her fund as tax-free cash, and she can take the rest of it subject to income tax. So if she takes all of her money, she's going to be in a pretty drastic situation. She'll end up, rather than £300,000, she'll end up with £212,950 in her bank account. Assume she's got no other income from any other sources. She's paying 20%, 40% and 45% income tax on the red part of this example. So she'll have nothing left in her pension, but she'll end up with £212,000 in her bank account, and she'll pay an eye-watering £87,000 or 29% of her fund in tax. Now, clearly, that's only going to be done in desperate situations. I don't think most people would consider doing that. But of course, if you've got a relatively small fund, if you've got, let's say, £20,000 in your pension plan, maybe you might consider doing this and paying a bit of tax along the way. So this is the situation once she's completed the withdrawal, nothing left in the accumulation stage, nothing left in the income stage, it's all in her bank account, and she's got a whopping tax bill to pay. Okay, that's not the best idea, in my opinion. Let's look at a second idea. Well, I just want a lump sum without paying any tax. Perhaps she just wants to take the maximum she can without paying any income tax. Well, the rules under flexible pensions allow you to do this. So this is a nice thing for many people. Now, I would counsel you would really only want to take this if you're going to spend the money, because what's the point taking it? You're taking the money tax-free out of your pension for it then to go into another type of investment and pay income tax or capital gains tax after that. So remember, in the accumulation stage, you've got no tax to pay on your pension plan. As soon as you take the money out and put it somewhere else, like in a bank account, you're going to start paying income tax on that money. So, but here's Sarah's options. She can switch all of her money from the accumulation stage into the income stage. She'll have no tax to pay on the £75,000 lump sum, and she can leave the rest of the money in her pension plan. It's a different type of pension, but effectively, to all intents and purposes, it's the same. It's just crossed that individual, that invisible line to the income stage. So, after she's completed the transaction, this is what's happened. Nothing left in the accumulation stage. She can continue to pay in, by the way, but in a reduced, or potentially reduced way if she takes any taxable income. She's no longer got her tax-free lump sum. It's been paid into her bank account. But she's left with £225,000 in her pension, still growing tax-free, and she's paid no tax on that withdrawal. So effectively, £300,000 is left. She hasn't paid any tax. She just transferred some into a different type of pension and some into her bank account. So she's no worse off in terms of tax. Just remember, you've got to do something with that money. If you're not planning on spending it, you may as well leave it in the pension plan because it's going to grow tax-free. Here, in the bank, she's going to pay some tax on it. Okay, so let's think about a sort of a slight difference to this second scenario. In the third scenario, Sarah's got a debt she wants to pay off. So we're assuming she's perhaps got a little bit left on a mortgage, and she thinks, well, do you know what? Rather than paying 3, 4, 5 6% on my mortgage rate, I can instead use some of my tax-free cash from my pension plan and clear that debt. Well, this is how it would work. So let's say Sarah needs £40,000 to clear her mortgage. So she started with £300,000 in her pension plan. We can cut this into two now. We can leave £140,000 in the accumulation stage and move £160,000 to the income stage. And the reason for that is that £40,000 is 25% of the £160,000. So she'd leave £120,000 in her pension. Perhaps she's still working, perhaps she pays higher rate income tax and she doesn't need the income for the time being, but she needs a lump sum for a specific reason to perhaps pay off a debt that is costing her a significant amount of money. So she's basically moved her pension money around, kept as much as she can, this £140,000 and this £120,000 in tax-free pension savings, and moved some of her money tax-free out of her pension into a bank account. And basically, like in the previous scenario, we're left with all of her money intact. Nothing's paid in tax here. So she can take that money and pay off the mortgage that's costing her interest. Remembering that the money that's left in the accumulation stage can be moved at any other stage in the future to the income stage. So she still retains 25% of this amount, which is growing, hopefully. No guarantees, of course, but this money can still grow by you can still take another 25% of this fund as a further tax-free payment in the future. So in that kind of scenario where you need a tax-free lump sum to pay a specific item, it kind of makes sense, provided you think about the future and the impact on your future income from taking withdrawals from your pension. I think that's a discussion for another day, but bear it in mind if you're considering taking withdrawals. So once that's complete, we're left with part of her money, £140,000 in the accumulation stage, and part of it's in the income stage. They're still growing tax-free, and she can move money across this line at any stage or out of here into taxable income if she wants. Okay, so let's think about sort of more traditional income sources. So if Sarah wants a complete tax-free income, I'm assuming she's stopped work at this point, she can use a combination of her tax-free lump sum and her income tax annual allowance, which is your tax-free allowance before you pay income tax, and she can actually take an amount out of her pension completely tax-free every tax year. So this is how it would work, and this is pension fund withdrawal as it used to be known. So it's an alternative to income drawdown that allowed you to take a combination of tax-free cash and taxable income. So you can do this in such a way that Sarah pays no tax on the withdrawal. So here's how the calculation works. She's got £11,500 of her annual allowance for income tax, and if we work out that £15,333 goes into the income stage, she can take 25% of that as tax-free lump sum, and the remainder would be a taxable income. But because she's got no other taxable income, she actually can take this amount out completely tax-free, meaning that £15,333 goes into her bank account without paying any tax, leaving the rest of her money completely intact and growing completely tax-free. So this is how it would look after the end of year one. She's retained the maximum amount that she can in her tax-free pension. She's taken the maximum amount tax-free out of her pension plan, and ultimately you add those two together and she's still got £300,000 of her original amount of her pension plan and paid no tax. Now that might work for some people, but it might not work for most people because of course that might not be enough income. You might need a shorter amount in the early years and a different amount perhaps once your state pension kicks in. So there are different ways to arrange this, which we will explore. So let's assume Sarah takes the traditional income drawdown route, which says I need a larger income actually now. I've retired from work and I want to receive £30,000 a year from my pension plan after tax. So this is how it would work under the sort of traditional drawdown income route. To be able to get £30,000 after income tax, Sarah's going to have to pay £10,711 in income tax to get that money out. So she needs to convert 42,844 into the income stage. Take the 10,711, which is a quarter of that amount, as a tax-free lump sum, and then a taxable amount of 31,133 as an income. Once you deduct the income tax from this amount, she's left with this plus the net amount after income, which totals £30,000. So she's going to have to pay just over a quarter of her withdrawal as income tax. Well, while that may be relatively tax efficient compared to getting money from earned income, it's not as tax efficient as I would suggest that she may want to examine a different way of taking money from her pension plan, and that's what I'll explore in option 6. So this is how it's left after year 1. She's got £257,000 left in the accumulation stage, and of course you can continue to divide off amounts year on year into the income stage, bearing in mind that perhaps if she takes £40,000 each year from this fund, even if it continues to grow, it's going to be exhausted at a certain point in time. But that's a conversation for another video. But in terms of tax, it's not as tax efficient as it could be. So is there a better way? Well, potentially yes. If she wants a larger, flexible, tax efficient income, especially if she wants a larger amount during the early years and is prepared to reduce her income down in a few years' time, perhaps when a state pension kicks in, or other guaranteed income from other pension sources, there's a different way that she can arrange things. So instead of taking taxable income, she can actually take two separate amounts that go from the accumulation stage to the income stage. So if she converts £74,000 into the income stage, she can, as in option 4, she can take tax-free cash and up to the annual allowance for her income tax, and take the £15,000 or so from that. She can also take another amount, part of which will stay in the income stage, but part will be paid as tax-free cash. So if she moves this part here, this part here, and this part here, the total of those come out at £30,000 without paying income tax. So she retains £270,000 in her pension plan, but she's paid no income tax on that withdrawal. Now, that is not going to last forever, because the more that she moves across from the accumulation to the income stage, the sooner her tax-free lump sums are going to be used up. But this can work very well if you know that there's some other income coming down the line. So perhaps Sarah's retiring or semi-retiring at age 60. She knows that there's some final salary pensions to come in at 65, and perhaps her state pensions coming at 67. So you can gradually stage in the flexible income from her personal pension plan to match the income that she wants over time. And eventually we can build the right level of income in a tax-free way or a tax-efficient way to meet her needs as her life changes. This is the situation after year 1. So she retains the majority of her pension in the accumulation stage, and some will be left in the income stage. But both are still growing tax-free. She's paid no income tax, and basically we're left with effectively the entire fund intact. Of course, she's going to spend this amount. So that's quite a whistle-stop tour through 6 different options. I think you'll agree tax-free means is better than paying tax. So you should explore flexible income in your flexible pensions to minimise the income tax you're going to pay. I would say, of course, that you should consider many other aspects other than tax when you're taking money from your pension plans, and obviously you should seek advice before you go into this kind of arrangement. Just a few things to sort of general principles to consider before we round this off. So, what is the money for? Do you need a lump sum to spend on a specific thing? Obviously paying off the mortgage, paying off a debt, buying a car, going on holiday, something that's a one-off item. Or is the money to live on? Is it income? And of course the approach that you take to your flexible pension will determine the way that you, based on your needs, that the way that you take the money from it. Ultimately, my biggest question is, are you going to spend this money? There's no point taking money out of your pension plan unless you're going to actually spend it. If you're going to just leave it in a bank account, you may as well leave it in the pension plan, because it's going to grow tax-free in that area. And of course, you can take it out at any stage you want, as long as you've reached age 55. And obviously, you've got to consider what your other income sources are. Number one, it's because we need to work out how much you need. You need to know when that income is needed, how long for, what is the tax implications, because obviously your other income sources may be taxed or taxable. So we need to think about the implications of all those together. But really, your flexible pension should be used, or could be used, to fill any gaps, especially in the short term. Of course, you have to think about how long you're likely to live and how long your pension is going to last. So there are other aspects to think about, of which a qualified financial advisor will be able to help you. But this video is obviously focusing on tax at this stage. Okay, so just one final thing then. Obviously we work with people like you who have money invested in pension plans and want to plan for their retirement, and we do that through our service called Prosper. So what we're aiming to do is to help to show you where your future is going. So we give you some clarity around where your money is now and where your money is going to go in the future, based on some realistic assumptions about how the future may go. Then we can start to look at different scenarios, and ultimately when we look at those scenarios, we can help you to visualize how your future is going to be, so that you can focus your resources in the right area to ensure you get the best return on your money and make the best choices for your future. Really what we're about is enabling you to be free in your future. So once you've got that freedom, you may improve your lifestyle in many different ways, and of course that's very personal. So thanks for listening. Obviously, if you've got any questions, our number is on our website, and please give us a call or send us an email, and we'll be happy to help.